The house is running out of time.
Look, I know how this sounds. Another person talking about precious metals like it's the answer to everything. But hear me out, because what's happening in the silver market right now is genuinely unusual, and I think it deserves serious attention.
I'm not here to sell you on some dream scenario. I want to walk you through the actual mechanics of what happens when a market built on leverage meets real physical constraints. This is about data, timelines, and structural imbalances that are already playing out. Let's dig in. Historical context. What previous rallies tell us. Silver has spiked dramatically before. Twice, actually. In 1980, silver hit $50 an ounce. You probably know the story. The Hunt brothers attempted to corner the physical market, and the system reacted hard. They changed margin requirements mid-rally, the price crashed, and regulators called it necessary intervention. But here's what's interesting. That $50 peak wasn't driven by industrial fundamentals or even monetary policy. It was a pure supply squeeze. Someone tested whether the paper contracts could actually be settled in physical metal, and the answer was uncomfortable enough that the rules got changed. Fast forward to 2011. Silver ran to $49 again. This time it wasn't a few billionaires. It was retail investors and some sovereign buyers responding to massive quantitative easing after the financial crisis. When central banks were printing trillions, people flooded into silver as an inflation hedge. The response was similar. Margin requirements increased sharply, concentrated selling in the paper market killed the rally, and silver got labeled as a speculative bubble. But here's what's different this time. Both of those rallies happened when the market could theoretically adjust. Mines were operational, refineries had capacity, and industrial dependence on silver wasn't nearly as structural as it is today. Those were price spikes in response to temporary imbalances. What I think we're looking at now is potentially a repricing, a fundamental shift in how the market values silver based on changed supply and demand dynamics. The variables have shifted significantly, and the market structure might not be able to handle it the same way. The industrial demand story nobody's pricing in. Here's where I think most analysis misses the bigger picture. Silver has evolved beyond just being a monetary metal. It's become absolutely critical to the energy transition, and that transition isn't market-driven, it's government-mandated with trillions in subsidies behind it. Solar panels require silver in their photovoltaic cells. There's really no substitute that conducts electricity as efficiently at the scale needed. Each panel uses roughly 20 grams of silver. That might not sound like much, but when you're installing over 300 gigawatts of solar capacity globally per year, you're talking about approximately 3,000 tons of silver annually just for solar. And that number is accelerating, not plateauing. Electric vehicles tell a similar story. EVs use about twice as much silver as traditional combustion engine vehicles, somewhere between 25 to 50 grams per vehicle in electrical systems, charging components, and battery management. Global EV sales are projected to hit 30 million units by 2026. Quick math. That's another 750 to 1,500 tons of annual silver demand that barely existed a decade ago. Then there's the infrastructure itself, smart grids, charging networks, energy storage systems. All of this requires silver because of its conductivity and corrosion resistance in high-efficiency applications. Here's what concerns me. Governments are mandating this transition without apparently securing the supply chain. The EU wants to phase out combustion engines by 2035. China is subsidizing solar and EV production at unprecedented levels. The US has committed hundreds of billions through various legislation. But I don't see anyone seriously addressing where the silver comes from. The honest answer is that it doesn't exist. Not at these volumes, not at $30 per ounce. The industrial demand alone is approaching available supply limits, and that's before considering investment or monetary demand. This isn't a typical commodity cycle. This looks more like a structural constraint that's being systematically ignored. The supply side. Why production can't respond. This is where the market structure starts to break down. Global silver mine production peaked around 2015 at roughly 870 million ounces. Since then, it's been essentially flat. We're producing around 800 million ounces annually, and there are real reasons why that number isn't climbing. Here's the key issue. Silver isn't primarily mined for silver. About 70% of silver production comes as a byproduct of mining other metals: copper, lead, zinc. That means silver supply is fundamentally tied to base metal economics, not silver prices. When copper prices are strong, you get more silver, incidentally. When they're weak, silver production falls, even if silver prices are rising. The market can't respond to price signals the way a primary metal can. It's structurally inelastic, which is unusual and important. The inventory situation adds another layer. The COMEX has physical silver backing paper contracts, but the ratio of paper claims to physical metal has been estimated at well over 100 to 1. That means for every ounce sitting in a vault, there are potentially 100-plus paper contracts representing ownership of that same ounce. It's essentially fractional reserve banking applied to commodities. And like fractional reserve banking, it functions smoothly until someone actually demands delivery. We might be approaching that moment. China and India have been drawing significant physical silver from Western vaults. In 2024, India imported over 7,000 tons, a record. China's imports are similarly elevated. Importantly, they're taking physical delivery, not just trading paper. Every ounce leaving COMEX vaults is one less ounce available to settle outstanding claims. The math is straightforward. Industrial demand is rising, investment demand is growing, mine supply is flat, and the paper market operates on leverage ratios that only work if physical delivery isn't demanded. If we see a delivery crunch, and I think there's a real possibility we will, the adjustment won't be gradual. Markets don't gently reprice when structural assumptions break. They gap. $30 silver could jump to $100 plus overnight if the paper market can't deliver, and that might just be the beginning if the underlying scarcity becomes undeniable. The gold-silver ratio, a powerful signal. The gold-silver ratio is sending a message worth paying attention to. Right now, gold trades around $2,500 per ounce, and silver sits near $30. That's a ratio of roughly 83 to 1, meaning you need 83 ounces of silver to equal 1 ounce of gold. Historically, that ratio has averaged closer to 15 to 1 over thousands of years across different civilizations and monetary systems. Even in modern markets, the ratio spent decades between 40 to 1 and 60 to 1. 83 to 1 is a significant distortion, and large distortions tend not to persist indefinitely. When gold moves to $5,000, which multiple credible analysts now consider plausible given debt levels and central bank accumulation, the mean reversion math becomes interesting. If the ratio corrects to just 60 to 1, silver reaches $83. At 40 to 1, silver hits $125. At the historical 15 to 1, you're looking at over $300. But ratios don't just mean revert, they overshoot during volatile periods. In 1980, the ratio briefly hit 17 to 1 during the peak. In 2011, it touched 32 to 1. When paper markets experience stress and physical scarcity drives pricing, silver historically doesn't just return to average, it overshoots significantly. $600 silver implies a gold-silver ratio around 8 to 1 if gold is at $5,000. Is that extreme? Absolutely. Is it impossible? Well, only if you assume that decades of suppressed ratios unwind gradually and calmly. History suggests that's not how these corrections happen. The macro backdrop. Why fiat concerns are growing. The monetary situation is no longer theoretical, it's becoming acute. Global debt now exceeds $300 trillion. That's debt that realistically cannot be serviced in real terms without significant currency devaluation. The path forward involves inflation, not the managed 2% kind, but the structural type that pushes people toward hard assets. Central banks understand this dynamic. That's why they've been accumulating gold at record levels. In 2023 and 2024 combined, central banks bought over 2,000 tons of gold. China, Russia, India, and Turkey are leading this accumulation. They're not doing this because they think fiat currencies are stable long-term. Here's an important distinction. Gold is for institutions and nations. Silver is for individuals. When regular people realize their purchasing power is eroding, they don't typically buy gold at $5,000 per ounce. They look for silver at $30, or they try to, because by the time this becomes mainstream awareness, physical silver could be significantly harder to obtain. The speed of this potential shift is what could create dramatic price moves. It's not a gradual reallocation, it could be more like a panic rotation. When pension funds, family offices, and retail investors all simultaneously seek the same limited pool of physical metal and the paper market can't actually deliver, that's when premiums on physical metal can explode. This represents a potential wealth transfer from paper claims to physical holders, from those trusting the system's promises to those who demanded actual delivery. Why 2026 matters. Converging catalysts. 2026 isn't an arbitrary date. Several significant factors converge around that time frame. The U.S. faces another debt ceiling situation in mid-2026, but the political environment for raising it has deteriorated. Interest payments on national debt are already consuming over $1 trillion annually, more than defense spending. The fiscal math is becoming untenable, and markets are aware. Simultaneously, mandated transitions reach critical mass. The EU's combustion engine phase-out is less than a decade away. China's green energy subsidies are peaking. The industrial silver demand that's been building crosses thresholds where supply constraints become undeniable even in paper markets. Additionally, BRICS nations are developing alternative trade settlement systems, potentially gold-backed, designed to reduce dollar dependence. If something like this launches in 2026, it could trigger significant dollar volatility, and when the dollar's reserve status faces challenges, all fiat currencies get repriced against hard assets. The convergence of fiscal stress, industrial scarcity, and potential monetary restructuring creates a unique environment. The paper-silver market might not be able to maintain current pricing structures through this. The timeline isn't certain, but the catalysts are visible and building. Final thoughts. Understanding the setup. Look, I've shown you the math and the structural issues I'm seeing. The system has some serious imbalances that deserve attention. $600 silver might sound extreme, but it's what the numbers suggest if you work through scenarios where paper markets can't deliver and physical scarcity dominates pricing. The industrial demand is locked in by policy, the supply deficit appears structural, and monetary instability could drive flight to safety flows that the small silver market can't absorb at current prices. I'm not telling you what to do with your money, I'm not a financial advisor, but I am saying the risk-reward setup here is unusual. Significant downside is limited by production costs and industrial demand floors, while upside in stress scenarios is, well, you've seen the analysis. Do your own research. Question my assumptions. But don't dismiss this just because the magnitude seems unlikely. Sometimes unlikely things happen because the underlying math demands it. I'll keep tracking this. Drop your thoughts below. I'm curious how others are reading these signals.